Hi guys, John here. I just wanted to do a quick video to show you how you can capitalize on some of the increased volatility for AMC. As you can see, the volatility is quite elevated. It's up to 300% for some of the strikes, or I mean, for some of the expiration dates. I think the May 28th is probably too soon. I mean, that's fucking tomorrow, so that's too soon to probably do any significant plays on. But if you're to go out to like the June 11th, June 18th contracts, I think you can probably find some good volatility plays here. I'd probably go with the calendar. Well, if you thought that AMC still had some upside, you can do like a call calendar. We'll choose a $30 strike. These are trading for about 40 cents each. So as you can see, this gives you a lot of upside potential up to like $50, $55 almost, and you actually have downside protection down to $18. So I would probably do this if I thought that AMC was going to settle around the $30 range, although you still have a pretty big range of motion here to play around with. So I would probably do that if I was bullish and wanted to capitalize on the increased volatility. If you're bearish on it, you could probably do more of a diagonal. And in this case, you would buy the 30s and sell the 28. And then so if it went down, this gives you downside, well, basically unlimited downside protection. And you still have significant upside potential up to like $40. So you could do that if you maybe thought that it could go up higher, but ultimately you thought that it might have more downside. I mean, even if you sold the $25, then you're really getting into a pretty big skew here, but you would have a pretty big upside risk. So that's one thing to do it. One thing I'll warn you about with the calendar is that they're very sensitive to Vega. So if you're to get like 100% drop in the IV, now in between the expiration date, you'll see that your calendar actually got smaller. So now you'd be losing money at $22 and $41. But I mean, that's still a pretty big range of motion if you thought that AMC had some upside to it. So that's one way to capitalize on it. Another thing that you can do is a risk reversal if you're bearish on it. We'll go to the June 18th ones for this. Risk reversal in this case would be, well, if you're bearish, I would do a risk reversal. You do it by selling a call and buying a put. So let's see, we'll sell the $35 call and we'll buy the $25 put. And you see, this is going to give you a graph that looks like this. So you'll see you're pretty protected up to about $35, and then that's when you really start to lose money if it goes beyond that. So what selling the call does is basically pays off the put. So as soon as it gets to $25, there's no break even past that. You just start making money. So that would be a risk reversal. If you were even more bearish on it, you can even sell the $20 put, and this would be profitable for you as long as it stayed under $35. And one way to protect your upside is to buy shares of stock. You can sort of do this by like you can call it delta hedging. Let's see. So you buy like 300 shares. So if you were to buy shares to hedge your upside, then this gives you greater upside protection, just in case it really did take off. Yeah, so if you're doing it with selling the $35 call, buying the $20 put, you'd have upside protection up to about $41 now. And you're still leaving yourself with pretty significant profit potential down to the downside. So that's the risk reversal. That's one way that you can also capitalize on a drop in volatility with the calls and really add on some extra cash if this thing were to really dive to the depths of hell. But that would require selling naked calls, which I know not everyone can do. Other than that, you can always do your verticals. Let's see what the 2015 would get us. 2015. Yeah, so let's see, 2015, you have a break even of $18. I mean, so this is with the June 11th expiration dates. I mean, so yeah, you would need this to drop down quite a bunch for you to start making money. But I mean, it's so high up right now that, I mean, it's not impossible or unthinkable. And then let's see, you're risking 1,700 to make 3,200 here. You can even be more aggressive if you really thought this is going back down to the tens, which I don't think it is, but I mean, it could. And then you're at about 4-to-1 risk reward, and your break even here would be about $14.15 if you're buying the 15 and selling the $10 put. So that's what I have for you in order to make money off of the spike in volatility off of AMC. If you guys have any questions or comments or other ways to make money off of this, feel free to comment and we can discuss it there. Other than that, good luck.